Hello and welcome to Asgard Updates. It's been a long time since I've done one of these videos. I'll be honest, the market's been kind of boring up until this year, but now it's getting quite exciting. And given the market decline that we've seen over the past few days, I thought it'd be good to get a little video out there just to describe what and how we see the world right now, and what actions might one investor take. And so if you found yourself here, this is Asgard Updates, and the intention of these videos is to give updates to the investors in the cold stream dividend growth strategies and kind of give a lay of the land. Now, I can't give specific advice due to the SEC, but I can give general updates and provide as much information as I possibly can, and hopefully share some knowledge that we have. Anyway, before I get completely started, I have to give some caveats. I cannot give personal financial advice over the internet. To give proper good financial advice, one has to know the makeup of someone's balance sheet, their income, their liabilities, and all the other aspects that a person might have. And I highly recommend that you don't take advice from random strangers on the internet and YouTube. So with that said, if you have questions, please reach out. I'm happy to chat, but let's get started on the basic overview of what we're looking at right now. All right, I'm gonna have to move my head here. There we go. So on this slide, basically, I'm just gonna give a layout of where I want to take this video. There's basically three pillars that I look at when I'm considering whether or not to be in the stock market, out of the stock market, and to what degree. And basically the three pillars of that is what we're looking for is momentum in the market. Is it positive? Is it negative? We're looking at valuations in the market, and both bond and stock market. Are stocks cheap? Are bonds cheap? Where are they going? And then we also want to look at economic conditions, whether it's strong or not. And by looking at these three pillars, it'll give us some insight as to what kind of exposure we might want to put on or take off. And then I'm going to end the video with some editorial commentary, and I'll get back into this at the end. But I'll give my strongly held opinions at that time. All right, so let me flip over my screen here. So this is a chart of the S&P 500. Move my head again. And this is the 3-year look. And right around here, you can see the peak that we had essentially on December 31, 2021. It's when the market peaked. And ever since then, the market's been in decline. And really the thing that's changed from 2021 to 2022 is the fact that inflation has gotten unbearably high, and policymakers are changing their policies in order to combat this inflation. And if you've heard me talk about inflation before, you would recognize I think there's two sides to inflation. There's the supply side and the demand side, and we essentially did both of those. We've created this inflation by creating a supply constraint and a demand stimulus at the same time due to COVID and the policies that flowed out of COVID. But you can see here in early 2020, the world went into lockdown due to the COVID outbreak, and the market declined by about 30%. Then the stimulus happened. On the monetary side, the Federal Reserve dropped interest rates to zero, began a massive program of quantitative easing, and basically told the market that they are willing to support the markets, particularly the bond market, in this emergency situation that we found ourselves in the pandemic, and that they didn't want to induce a recession, or they wanted to mitigate the recession at that time as much as they could, because this was a policy directive. And from there, the federal government then was able to produce a ton of stimulus in the form of direct stimulus, in the form of PPP, which is the Paycheck Protection Plan, that gave essentially forgivable loans, which I would call them a grant, to businesses to pay payrolls and to pay rents. And that injected a massive amount of money into the business community. At the same time, they also had direct stimulus to individuals, basically sending checks to everybody. And so they stoked demand, they gave everybody money to spend. But at the other end of the spectrum, all of our supplies were being constrained. Factories were being shut down. You couldn't go to this. Many stores were shut down, and small businesses were shut down, and so you were constrained to what you could purchase. And so the things that you could purchase, like lumber, we saw dramatic spikes in the prices of those things. Anyways, this is all history. At the moment, though, now we are experiencing the fruits of all of that stimulus. Massive stimulus causes higher prices. And then, of course, we've got the icing on the cake, which is the war in Ukraine and constrained oil potentially coming out of Russia. And so oil prices are high. And then, of course, now we have another bit of new news, which is the fact that China is shutting down due to their zero COVID policy. And I think at this point, Shanghai's been shut down for about 6 weeks. And then portions of Beijing now look like they are starting to lock down, and there may be more. And so, again, supplies coming out of China, particularly in finished goods, are going to be constrained this year. They've been locked down so long, that's probably going to mess up the supply chain for basically all of 2022. And of course, we do import a lot of stuff. And so the thing that is happening is that interest rates are rising. The Federal Reserve can no longer pursue their emergency accommodation. So what they've done is they've stopped printing money, quantitative easing, and they've also begun to raise the Fed funds rate. And as it stands today, the Fed funds can be about 75 basis points, 85 basis points in that range. And they just this week had a 50 basis point increase in the Fed funds rate. And so the market initially digested that and said, okay, that's good news. But then yesterday, market went down. The Nasdaq was down 5%. And I'll editorialize into why I think we're experiencing those things. But that's the facts. And so looking at the charts, again, this is a momentum analysis. What we're looking here for is what is the pattern? And I can tell you that the pattern has changed. We had a bull market. And so in a traditional bull market, the market is leading. These little blue and the red lines, those are the 50-day and the 200-day moving averages. And generally in a bull market, you can see you get the market will move up to a new high, or a stock will move up to a new high. It'll regress, pause, go down to its moving averages and kind of bounce off. And you see that pattern repeated over and over again. Even, sometimes it'll violate, but generally that's the pattern. You hit your moving averages. Those moving averages are generally support as you fall down to them in a bull market. But then you get into a different kind of market, and that's what we're getting right now. You have the market leading your moving averages down, and you can see there's some congestion here around moving averages. As the market ascended towards the end of the quarter, it got up and over its moving averages, but then the momentum faded off, and it's now looking like these moving averages are resistance. And so this is essentially the formation of a bear market. You have a series of lower highs and lower lows. And this is the S&P 500. This is just the total market in general. And I don't think that's indicative of all stocks. And so this is where we have to start making some distinctions here. So this is the Nasdaq 100. This is an ETF, a chart of the ETF of the Nasdaq 100. And so the Nasdaq is heavily concentrated in tech firms. And one of the characteristics that we've seen over the past couple of years, you can go back and see some of my other videos. I have one called Get Off My Lawn, describing the high prices that we were seeing in late 2020. We have very high valuations in these segments. And as interest rates rise, one would expect PE ratios to decline. And so basically, despite the fact that if you just were to take all of the earnings in the NASDAQ, those earnings are growing. We're actually in a pretty good situation in that regard. The momentum on this has decidedly turned negative. And that's because the PE ratios that investors are willing to pay for a company are starting to come in. And you can see that this decline is a bit more precipitous than the market in general. These lows are lower. I mean, it's quite a bit off its all-time highs, and it is decidedly making lower lows. And it's even more dramatic in this fund. So this is ARK Innovation ETF. This is essentially an ETF. This is Cathie Wood's. It's an actively managed ETF, but generally the character of the holdings that they have in this fund are money losers. These are companies that don't have any earnings, very light revenue, but they have business plans that might get them there in the future. They have exciting technologies that may create new markets, all kinds of. These are things that people would look to and go, oh gosh, in the fantastic future, this may be worth a lot of money. And many people got sucked into that trade. 2020 is probably the best performing fund. It peaked in February of 2021 and it's basically sold off around 70, 80%. I think probably about 70% at this point. And it looks an awful lot. If anyone's been trading since 2000 or 1999, this is where I kind of cut my teeth. It's just like the dot-com bubble. You have a bunch of money-losing businesses with nearly infinite valuations. And even those that do have some earnings, their valuations are absurd and basically bubble land. Well, they're all on sale now and they're getting cheaper. And I don't know where this pain ends. If it's anything like the Nasdaq at post 2000, there's still another 20, 30% to go before this starts to recover. And even then, there probably won't be a recovery. If anyone remembers how the Nasdaq behaved post 2002, it's a 60% decline plus and flat for basically a decade. So if history repeats, that's probably what's in store for these companies, because eventually these companies are going to have to produce earnings. They're going to have to convince investors that their earnings are going to grow, that they're taking market share, and that they're a profitable enterprise. And then, of course, they're going to have to be valued appropriately as a profitable enterprise. And so that takes time, particularly all these businesses that have these really long kind of run rates in paths to profitability. Now, on the good news, the momentum here, what you're looking at is a dividend ETF. So this is the highest dividend payers in the market. Now, this thing is heavily weighted towards utility companies, energy companies, consumer staples, and those kinds of things. Financials are heavily weighted in this as well, and particularly like the insurance companies, right? They are performing quite well. The banks and stuff, not so much. But you can see that this is still a bull market, right? The moving averages are sloped upwards. The market is, this fund is trading around its moving averages in a positive direction, despite the fact that the entire market is selling off. So, right, you look at the S&P, it's declining, making new lows. This segment, which is, a good proportion of the market, is still in a bull market. If we were going into recession, you would expect these companies to be declining. In a recession, it doesn't matter what kind of, if it's a true recession, earnings are going to be declining. The price of these stocks should be coming down. What we're observing here is that very expensive companies are selling off. Companies with earnings and low valuations are continuing to ascend on the basis of their earnings growth. And so this is still a bull market. This is nearly identical to the market that we saw in 2000, from the period from 2000 to 2002. If you were out of tech, if you were out of the high PE stocks, you could make money. If you bought Berkshire Hathaway and Exxon and Chevron, and basically these, kind of boring businesses, you could have made money from 2000 to 2002, despite the fact that we were going into recession. And again, that recession came pretty late in post 9/11. And one more point, if the market were pricing a recession, this chart would probably look like this March of 2020, which is this period right here. Earnings were in decline. Everyone knew that the economy was going to have a really tough time post-COVID. And so you can see all stocks, growth stocks and value stocks, all sold off at the same time. And that's what a recession looks like. What we have here is something very different. And I think it's a manifestation of a bubble bursting. The slightly different chart, this is literally half of the market. This is the value end of the market. So if you were to take the stock market, cut it in half and say, here's all the expensive stocks on one side, here's all the cheap stocks on the other side. These are the cheap stocks. Again, despite the massive negative pressure that we've experienced over the last few weeks, these stocks are continuing to perform. They are currently sitting at the 200-day moving average, this little red line right here, and that's the battleground. They have sold off a bit, but not nearly to the degree that we're seeing in tech and in high valuation growth stocks. All right. So that's the momentum picture. It's decidedly mixed, but there are pockets of opportunity. And literally half of the market's working, half the market's not. That's the takeaway. All right, so let's go over and talk about valuation. So this is our ISG chart deck from Coldstream. Here is a valuation chart on the S&P 500. And this is a forward PE. So this is take next year's earnings relative to the current price. We peaked basically at year end, and we've been in decline. And two things are happening. It's happening at the same time. Earnings are coming in, they're coming in strong, valuations are coming down. We are still in the expensive portion of the the expensive side of valuations. My concern here, and if you can look at this period post-bubble in 2000, that's where this kind of chart starts in 1997 and ascends all the way into the top of the bubble in March 2000, and then it starts to decline. And you go back to somewhere near fair value, that took you all the way to 2003, and then you continued all the way into the financial crisis. Valuations, I remember this pretty vividly, like 2003, 2004, stocks went out of fashion. Retail investors were not interested. Everyone basically went into real estate and were looking to real estate for their investment returns rather than the stock market, because everyone just got burned in the bubble. And we're probably setting ourselves up for something akin to that again. If history is past its prelude, the pattern we might be seeing is, as interest rates rise, valuations come down. Question is, how long are interest rates going to rise? And will stocks just completely go out of favor? I'm not quite sure about that, because there is pretty dramatic earnings growth. We are still a fast-growing economy. We have a dynamic industry, and we're creating new products, and we're creating entire new industries. And all those kinds of things are positive things that are happening that simply weren't happening in that period of 2002 to 2008. That entire economic cycle was almost financial engineering. It was just, it was real estate and construction, which are not really durable economic activities. They don't really add much value. If you look at the makeup of our economy now, we're bringing a bunch of industry back home. We're creating, all kinds of new technologies and battery technologies and electric cars. You name it. We're bringing a lot of new innovation to the U.S. and a more dynamic economy than we had in that kind of post-bubble period. So I'm optimistic on that. So I'm not so sure that the stock market is going to go completely out of favor and everyone's going to reject it and see ridiculously low valuations. But I would posit that so long as interest rates are rising, you are going to have pressure on these valuations, and we're likely to continue to see them come in. Earnings growth, which is the other component of the valuation analysis. If earnings are declining, valuations should be even lower. But if earnings are growing, valuations could probably stay a little bit higher. The bottoms-up analysis is still quite positive. I think the consensus is still for around 10 to 12% earnings growth this year. That's probably going to come in a little bit, but it's still positive. The corporate guidance and bottom-up analysis is not indicating a recession at this point. It's always on the, it's certainly always plausible or possible. We can have new shocks that were unanticipated that could cause a recession. But as it stands right now, the momentum in the economy itself is quite strong, and the earnings momentum is quite strong. So we do expect continued earnings growth. But that is going to be counterbalanced by the fact that valuations are coming down. So you have your valuations coming down, your earnings coming up. It's going to be a tough road for the stock market to make dramatic appreciation. We're basically digesting, the big move that we've had in the last 3 years. All right, and then let's talk about economics real quick. Obviously, the elephant in the room is inflation. It's extremely high right now. By every measure. There was some movement in the last month in core moderating, core inflation moderating, despite food and energy prices going up, which is the non-core component. We are hopeful that inflation will start to moderate from this 8% level. If you look at what the market's pricing in, the bond market itself uses this thing called the tip spread. I think I've got that over here. Pull that up. Oh, got to go the other direction. Here's our tip spread. This is a bit stale. These numbers have moved since, but I'll draw your eye to this black kind of box right here. That is the 10-year expected inflation rate built into the tip spread. So tips are inflation protection bonds. And so what you're looking at is the difference between a bond that pays CPI and a nominal bond that pays a fixed coupon. The difference between those is basically, these are trillions of dollars in both of these bets. It's basically what the market has decided inflation is probably going to be over that period. And it's probably our best guess. And it's objective. I can observe it. And so I like to use that as my own base case, maybe adjust it, if there's some other information out there but at this point, I think it's the best predictor that we're going to get. That number is sitting right at 3% right now. So it has moved up, right? As we continue to get these higher inflation numbers and the fact that all of a sudden China shut down, those numbers have moved up. And so we are going to get some components of inflation that are probably going to stick around. Obviously, wages are going up. Labor's in short supply, and so wages are going up. And so that's probably going to be a durable 1 or 2 more years at least phenomenon. But on the supply side, right, when China does open up, our supply chains are loosening up. There was a massive inventory build. Basically, businesses are buying inventory. And as they do that, obviously, the price of all their inventory components are going up. Well, the inventory builds are starting to ebb off right now. And the other thing that not a lot of people are talking about, but because it's such a recent event, is the dollar. And I don't have a good chart. I should pull the chart for this. But the dollar has been ascending relative to the euro and the yen and the Chinese yuan dramatically. So that improves our pricing power. If the dollar is going up and we import a lot of goods, which is what we do, that should moderate inflation to some degree. So there's no new stimulus coming, right? No new checks are being handed out. The Federal Reserve has moved from emergency accommodation to removing emergency accommodation. We have higher interest rates. If you go look at a 30-year mortgage right now, it's probably going to be about 5% plus. We're removing all the things that were causing the inflation, at least starting to. And so moving forward, we expect inflation to moderate. Where peak was, it's hard to speculate. Looks like I'm hoping March, maybe April. It's going to be the peak levels of inflation. But there may be more shocks coming. So that there's always some unknowables here. But as it appears today, we're going to start moving towards an economy that looks a lot like pre-COVID. So 2019, we're going to have full employment, growth, technology is going to start pushing down the price of production again. And so those forces, in fact, interest rates, all those kinds of things. So it should start moderating inflation from here. And so that gives us a degree of optimism going forward. And it also, what that means in particular for me, if inflation starts to moderate, the Federal Reserve will not be forced to raise rates to a restrictive policy. So if you could think about Fed policy, there's emergency accommodations, their fancy word of free money for everybody, like we're going to print money, we're going to set rates to 0. There's a neutral zone, and then there's restrictive. So the neutral zone is probably somewhere around the prevailing kind of inflation expectation. So it's going to be somewhere around a Fed funds rate of 2 to maybe 2.5%, 3%. Like that's probably the neutral zone where those interest rates aren't really high enough to induce a recession. Like no business, if they're borrowing at 6% and it goes to 7 or 8%, it's not really going to blow up their business plan. But if the Fed then starts taking the Fed funds rate up to 4, 5%, we've seen this in the past, and then all of a sudden your credit card interest rates are, are going up. It's going to hurt consumers. Your mortgage rates are going up. So all those kinds of things can induce a recession if they get restricted about it. They will induce bankruptcies. There will be businesses that borrowing at a 9%, and all of a sudden it goes to a 14, 15. They can't afford that new interest rate. They go bankrupt, or at least the market perceives that these companies can't pay that kind of interest, and so they will default. And so you'll get a rash of bankruptcies amongst unprofitable businesses. So my guess, I guess I'm shooting ahead to the editorialization portion of this call, but the guess is they're going to get the Fed funds to this neutral range and probably pause. And they can pause if the inflation indicators are coming down. If they're coming from 8 and they're glide sloping down to a 3, there will likely be a pause. And if that's the case, we have more time on the economic side. Other kind of good things about the economy right now is our labor force participation rate. We still have a lot of people that can come back into the labor force. There is some slack in the labor force that left probably due to COVID, childcare, all the other restrictions made employment unpalatable, and there was stimulus. So there was some wiggle room for people not to work. As we get further and further from that stimulus, we would expect more and more people to come from outside of the labor force and back into the labor force. Of course, we're always creating new workers as well. So I'm going to share a different chart. And this is the US leading economic indicators. And so I draw your attention to this blue line. So the LEI, as it's commonly known, is 10 indicators of future economic activity. And so it's things like unemployment claims, it's the level of interest rates, it's the shape of the yield curve, it's credit spreads, orders for goods, consumer goods and durable goods. And all those things put together give you a nice picture of, is the economy expected to expand, contract? So the call that's important for us as investors is, are we going into recession or not? If we're going into recession, the market decline will be dramatic in magnitude and duration. If we are not going into a recession, the magnitude of the decline in the stock market is usually muted and the duration of it is generally short. So looking at the LEI, right now it's growing basically as fast as it can grow. Our economy is growing fast. That should support earnings and that should support the stock market. Now I'm going to put a caveat on that when I get to the editorialization, because there are certain stocks that will not participate despite the fact the economy is growing. And so I'll talk about that in a little bit. And then I was just going to show one last chart. This is total payrolls, and this is just how many jobs are we creating. And you can see that this is continuing to ascend. We continue to create a ton of jobs, and you don't necessarily get recessions under those conditions. All right, so let's go back to my editorial commentary. And so this is personal opinion. These are not facts. Hopefully what I was sharing before are facts. That's the Mosaic. That's what we're looking at. And this is where my head is at the moment. I believe we had a bubble. By all observations, the valuations that we were seeing, in particular in certain segments of the stock market, those were unjustifiably high. They are now moderating. They will probably continue to moderate until such time as interest rates stop going up. So again, the Fed has described where they're going to take rates. I think they're being a little more aggressive than they actually intend. Again, that's an opinion. My colleagues, are on the other side of the coin and would say that no, the Fed is aggressive. They're going to raise rates until they break something. I'm of the mind. I look at the current makeup of this Fed board, and I just don't see that kind of virulence that they're going to get there. They don't want to induce a recession, they'll probably, if you look at their past behavior, and if that's prelude to their future behavior, they're not going to greenspan us and throw rates up so high that they induce a recession. But that remains to be seen. I think, again, high PE stocks, if you're in them, they're probably dead money for a long time, and they're probably going to continue to decline until they're value stocks. One way I look at the market is who's buying what. Retail investors are probably going to start, you hear sparks of people, oh, I want to continue buying these, these high flyers, they're going to come back. But, when you look at a business that's trading 40 times earnings, 80 times earnings, and they're growing at 15%, that's probably unjustifiable. They're probably going to, that valuation is going to come down, just like it did post 2000. And the fact is, in that environment, in this future environment with higher interest rates, if you can get a risk-free 10-year treasury bond that's going to pay you 4%, or even better, a nice high-quality municipal bond that's going to pay you tax-free 4%, paying 80 times earnings on a business that has very little earnings and dubious prospects looks a heck of a lot less appealing. And so there's going to be a lot of investors that are going to be shifting out of these stocks and into bonds as rates go up. And so my read on that is, look, we've got a long, probably ugly road for those stocks. Now, that doesn't mean that if the whole stock market's bad, you can rebalance and you can overweight dividend stocks. Those kinds of stocks are holding up quite well. They're still in a bull market. Their earnings are still growing, so long as we're still growing our economy. So the other kind of factor, I think that we're staring at the face of potential recessions in both Europe and in China. China might grow. I mean, their growth rate's so spectacular that they might still eke out, but it's the equivalent of a recession. Their GDP growth rates will probably be very anemic this year due to the shutdowns and the zero COVID policy. And it looks like they're sticking with it. And then likewise, same in Europe, their energy prices have skyrocketed due to the conflict in Ukraine, and that will likely induce a recession there. Interest rates will probably continue to rise to historical real yields. And so if you look at just where do we think interest rates are going, historically, a 10-year treasury is going to basically give you that inflation expectation plus maybe 100, 150 basis points. So if we got a 3% expected inflation rate, it's probably going to go to a 4.5 would be fair value to be historical norms. And I think that's probably where we're headed. In general, markets don't tend to trade at fair value. They go from overly optimistic to overly cheap. And so if you were to do that, you're probably going to get this kind of 4.5%. I don't think anyone else is forecasting that high a 10-year rate. I think most forecasts that I've seen are in the realm of 3, and we're already there, maybe 3.5. But again, I think markets tend to exaggerate the movements that they're already making as people just get shaken out of a trade that they might have had confidence in once that all of a sudden they start selling it. So that's where I think real yields are going. That's where I think interest rates are going. That again is going to put big pressure on multiples. And so again, on portfolio policy, you really want to look for companies that have a very low valuation ratio and maybe a high dividend yield, and that's going to insulate some of this PE compression effect. And then value dividend, it's the last bullet point there. So there are places to hide. There are things that are working. The market has sold off. It is pretty dramatic and upsetting, but try to keep it in context that we've had a massive bull market that we're working off of here. Best guess, we're probably closer to the lows here, the interim lows. I think we're about 15% off, 14% off from peak. We could probably see 20. That wouldn't be terribly surprising. And that's probably where the whole market might kind of moderate to. But there's probably some other future legs down for these very high PE multiple stocks. And so I want to be wary of that. But base case is we're not going into recession. These dips are buying opportunities in general. And so we probably have more time. The thing that we're going to be watching going forward is Fed policy. It is the most important variable to be looking at. And so you basically look at two things. You look at inflation rates. And so there's all these different measures of CPI, PCE, all those different indicators. They need to be trending in the right direction. And if they're trending in the right direction, then you can look at the Fed and try to decipher what they're saying and where they're going to take policy. And if they start raising rates to an area that, remember that, above neutral and go into restrictive, then we do need to change policy. Then it is, you might want to lighten up on stocks. In that environment, cash is going to be your friend, maybe even commodities and other areas that are outside of the traditional stock and bond market. So that's what we're keeping in mind. I'll keep watching and I'll keep producing updates. And obviously, if you have any specific questions about your portfolio or what we're doing and specifically, give me a call, send me an email. I will be happy to chat. So hope you found this informative. Again, call me up if you need anything.